Hey, good afternoon, everyone. We have a lot of traders coming into the room. I'm going to be starting in about 1 minute. Thank you. Hey, good afternoon, everyone. This is Mark from Right Line Trading, and I really appreciate you giving me your time. Um, I'm going to be previewing our full system, which has undergone some significant upgrades, and really I think is just a tremendous system. But I'm going to also provide you, I think, with a lot of good academic information regarding trading methodology that you can take home, whether you're interested in the platform or not. So I always try to make my webinars as informationally heavy as possible, and so hopefully you're gonna get something really good out of this that you can apply to your own trading. Now, quick disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or subscribers are for educational demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures or forex markets or for any profits or losses that may be incurred. Participating in trading the forex, futures, and stock markets involves substantial risk. And obviously, we all understand that you can lose a substantial amount of money. So participation in these markets may not be appropriate for everybody. Those of us at Right Line Trading are not licensed commodity trading advisors, and we recommend you may want to consult one before taking a trade. With that said, what I want to do is first go on to the oscillator analysis, because I think it speaks right to the core of our generalized trading methodology and what we look for in terms of taking a trade. Now, George Lane created the oscillator, and actually what he created was stochastic, and he did that back in 1957. And he was really quite a brilliant guy. If you Google his name, you're going to find that he was a mathematician. And he did a lot of other things in the field of mathematics in addition to this. But back in 57, he did this when there was really only very, very rudimentary charting available no sophisticated types of indicator analysis. And he made what was almost the first indicator. Now, I mean, MACD may have been created before him. I'm not sure. This is one of the first indicators ever created. And what he looked at was an indicator that would calculate momentum. Now, it's really important to understand that momentum is a second order derivation. And I think the best way to understand momentum is through this analogy. That if you take a race car moving around a racetrack, and it's moving at a constant speed of 150 miles an hour, its momentum is constant. And if the oscillator could somehow assess that, it would just be a straight line, because there's no acceleration or deceleration. The speed of the racing car is unchanging. And what momentum would be if the race car was consistently gaining speed over every incremental period of time. So every 30 seconds, it just didn't go 10 miles per hour faster. It went 10 miles per hour faster, then 20 miles per hour faster, then 30 miles per hour faster. That speed has to be constantly increasing in order for momentum to be increasing. So the velocity of the car needs to be increasing, or the change in velocity of the car needs to be increasing over each unit period of time. So he applied this to price movement on a chart. And what he felt was that momentum always led price, because it was a second order derivation. And as I show you a couple more slides, you're going to see that it really does lead price. So what he looked for was only one thing when he created his oscillator. And that was, he did not look for it to follow a trend. He simply looked for the oscillator to reveal bullish or bearish divergence. And what he looked for, or taught people who wanted to study this indicator, was that he was constantly fading price. He was never going in the direction of price, or again, using this indicator to track the direction of price. I sort of pretty much went over this, with the race car. What we're looking for in the rising price of a financial instrument is simply that at the close of every candle on a long move, the close of the candle is constantly approaching the high of the candle. As it continues to move up and approach the high, momentum is increasing to the upside. On a down close, we want the close of the candle to continually approach the low of the candle, and then momentum is increasing to the downside. Now, this is the oscillator formula. The reason I'm going into this is because this is going to fall back directly into our whole trading methodology. Now, C is the most recent closing price of the candle, and that is compared on a long move with the highest price traded with the average high price of every candle going back 14 periods, or 14 candles. In a short move, excuse me, it's compared with the average of the lowest price of the previous 14 candles. So you can see what he's doing. He's looking for the close to approach the average low, and for the close to approach the average high. And that's what tracked the percent K. That is essentially your percent K line. And your percent D line is simply a 3-period moving average of percent K. And when the percent K line, which is faster, crosses the percent D, you have a trade. And in a perfect market, which may have existed back in 1957, during a period of time when I believe our trading methodology would be quite different than it is, divergence really was, I have to believe, a very successful indicator. And I'm going to tell you why that is when I get to really the core of our trading methodology. This is a double top, and you can see that price moved up to the top here with lower momentum. That means that price accelerated up to this high faster than it accelerated up to this high. It kind of moved up here, but with decreased acceleration. And that decreased acceleration would herald an ultimate collapse in price. And in this case, price tried to make a third top, failed, and then collapsed. And this is a slide that I made showing price making a higher high on equal momentum. Now, when price makes a higher high, you want it to accelerate up to that high at least as fast or faster, actually, than it accelerated up to this high. If the price is higher, you want it to accelerate up to that price faster. When it simply accelerates up equally as fast, that also shows you that momentum is waning. And in this particular case, it was correct. And it was the harbinger of a complete collapse in price. And that's a divergence failure that I created. I don't like the slide. I'm not even going to bother with it. Now, we all know that divergence fails a lot of the times. We're going to talk about what's happened in the market in the last 5, 6, 7, 8 years or so that's really made things very, very different. Now, this was just a slide I pulled off the internet on Facebook that went back to the late 50s, where when price dropped across the 80 line, this is the percent K line or the momentum assessment line, you'd get a sell signal and price would fall. Here's the percent K line. Let's go to here, rising above the 20 line. See the up signal, and price rises. Now here's a failure as we get across to the percent K line across the 80 line. Here's the other cross, big move down, and now a big move up. And here we're just moving sideways. We don't know what's going to happen here. But you can see how well this assessment of momentum did in predicting the future movement of price. So here's what happens more likely. So here's what happens more likely in today's market. The oscillator goes to overbought, but price continues to rise. And we all know that an overbought situation can continue on and on for a significant period of time. It doesn't necessarily herald a collapse in price. So something different is taking place in the market today that has created an environment in which divergent signals fail at least as often as they're successful. And here's what's really happened. And this, I think, really has to be taken into account when you trade. Now, back when oscillators were developed, there was little or no institutional volume in the market, which meant essentially that the power of each individual buyer was approximately equal to that of each individual seller. Without any institutional money, we're all commercial traders. And as a huge cohort of commercial traders, we all have approximately the same power. Obviously, we're going to have traders that trade 50 contracts and 40 contracts, but in general, you don't have any single institution throwing in thousands of contracts to change the direction of price. But this is no longer true. Now institutional volume dominates, and they determine the direction of price. They create the multi-time frame trend. They take chop and they create a trend out of it. And if you try to fade the market against the direction of institutional money, you're going to get hurt. So this has changed the face of how we trade and changed the way an oscillator needs to be traded. Now, if you try to trade counter trend, or you try to trade oscillator divergence, it's going to work sometimes and it's going to fail sometimes. And when you can't determine when it will work and when it will fail, you cannot use it. The major goal of a piece of software is for you to be able to determine risk on entry. And when a signal is going to fail or succeed, and you don't know when, and you can't make an assessment of when, then you have to step aside on it. And divergence is one that's really going to cause problems for you if you use it. And this is the reason. It's institutional money. Now, I'll just tell you as an aside that this is the reason that Elliot Wave has been completely demolished, the reason that Gann theory has really been run over, and the reason that Fibonacci has also, in my opinion, taken a beating. Back when all of these things were postulated, the power of each buyer was equal to the power of each seller. And you can throw into that batch Japanese candlestick patterns. Now, I still love them. I still like to read them, and I still rely on them to some extent. But when the Japanese rice traders created them 400 years ago, there was no such thing as institutional money. The power of each buyer equaled the power of each seller. And therefore, those patterns had a lot of power. And although they still have meaning in today's market, the power of Japanese candlestick patterns has really, really waned. And if you take a look at an institutional move, and I'm going to show you on a platform, you can have crude go up 3, 4, 5, 6, 7 points straight up. Now, where's the 5-wave Elliott pattern in that? Where's the Gann analysis in that? And what does that do to Fibonacci resistance or support? It's going to crush it. So these programs that interpret where the market is going to go based on some intrinsic waveform or some intrinsic pattern or some mathematically predetermined retracement period is really, really going to be a problem for you. So in this era of institutional volume, I've created what I believe is the only way that you can successfully trade. And we make money almost every day in the live trading room. And one of the reasons we do is we believe that there's no such thing as overbought or oversold. If you believe that it can be mathematically determined by an indicator or any set of indicators, that they can tell you when there's going to be a high or a low, you are really going to have a problem. Because the high or the low is created solely by institutional money. they can push the market as far off the mean as they want to, and it's simply going to retrace to the mean when they're excuse me, when they're done with it. And the problem is you never know for sure when they're done. So the only direction that you can trade is in the direction of that big money. Market reversals are only going to occur at the whim of institutional money only. They're not going to they're not going to reverse on any kind of MACD divergence, oscillator divergence, on any kind of waveform pattern like Gann theory or Elliot wave. It's this big money that's going to do it. And they don't look at any of that. When they decide they want to smack crude or gold up, they do it. And they run over everything. Now, reversion to the mean still applies, but really the concept's been skewed. And the way I look at reversion to the mean is this. You can decide what your mean is. It can be, I like a 50 period moving average. That's the average price going back over 50 candles. You can take a 100 period moving average. It's irrelevant. Whatever you decide, eventually price is going to come back to that mean price. That's a mathematical axiom because that's the mean mathematical price. The mean price determined mathematically. The farther out the institutional traders push price, when they step aside, the faster it will snap back to the mean. The problem is determining when they step aside, and there is nobody that can do that. So you can't call a high and you can't call a bottom. You can try, but you're going to be wrong probably 2 or 3 times to every time you call it right. And I've tried every single thing possible. You take a double bottom off a pivot, a double bottom off a fib, a double bottom off of whatever. They're going to fail repeatedly as long as institutional money still wants that instrument to fall. So trading divergence is like trading against the flow of institutional money. And you can only trade in the direction of money flow. So that's our only job, I believe, in the market, is determining the direction of big money. And again, there's a lot of software that says they can do it. You cannot do it directly. All you can do is track sort of the footprints that big money leaves behind, and try to always be just a quarter or an eighth or a 16th of a footprint behind. That's all you can do. If you try to walk in the other direction, you're really, really going to get beaten up. And there's always traders that do. Now, I wanted to show you the Laguerre, because the Laguerre, I believe, is the premier oscillator for looking at momentum. And I've assessed the momentum of multiple indicators. We've used all the stochastics. I'm going to show you relative strength. I'm going to show you percent K, and even MACD creates momentum. And there's even Heikin-Ashi momentum. But all of these momentum indicators are all variations of stochastic, of George Lane's stochastic, and they are really created to track divergence. And they are not created to track money flow or the direction of the trend. The Laguerre is the only exception to that. Now, it has a defined gamma, and it has multiple filters. You define the gamma, I should say, and it has filters. And what these do is determine the speed of the Laguerre line and the stability of the Laguerre line. The faster the line, the more likely you're going to get a winner, and the more likely you are to get faked out by a false positive or a loser. The slower the line, trade with more specificity, but you're going to have to let more winners get by you. So there's a trade-off between speed and stability, and I believe the way we've set the filters in the gamma, we have a really, really nice trade-off. Now, here's the way our Laguerre functions. We trade in the direction of the Laguerre. And when the Laguerre becomes overbought and everybody else is looking to fade the market, we believe that institutional money is creating significant buying pressure in the market. And really, it's exemplified. This is a 30-minute of the Qs. Now, the Laguerre assessment is independent of the instrument. It's independent of time. Doesn't matter whether you're trading a daily, a minute, a time, a tick, a Uni-Renko. It's all irrelevant. It's a universal force that determines the future direction of price. And you can see that's the Laguerre arrow. The Laguerre is heading up. And just by virtue of the fact that it's heading up, it tells you that momentum is increasing as price goes up. And once it locks long, you get this green line. And it crosses the 80 line and you don't lose that green line until it crosses below the 20 line. So you can take this as far up as you want and exit at the down arrow, which is the cross of the Laguerre line across the 80 line, or on a break of support. The point of the slide is that we look for the Laguerre to lock long, and we stay with it, and we trade long. We don't ever look to fade the market. And here's a better example of the Qs on a 60-minute. And I wrote, I like the 60-minute chart the best. It really is the best. There's the Laguerre cross of the 80 line to the downside. Momentum, and forget this yellow line. We eliminated it. It's supposed to be an assessment of volatility and to help you determine how far price may go. But because of institutional money, it has been rendered irrelevant. It's a throwback because it looks a lot at the ADR ADX calculation. So momentum starts heading down. There's the cross. And then we get exactly what we want, the lock of the Laguerre to the downside. And once it locks down, we just continue to trade short on what is essentially increasing momentum. Now, I've looked at unbounded indicators, but all you need is a lock of the Laguerre to the downside, and you have sellers putting huge selling pressure on the market. Locks up, you're going to see that we consider this a counter trend trade and we don't take it. Here's another trade. This is on the Qs. And I don't want to get bogged down in this. The reason I spent a lot of time here is because this really encompasses part of our trading methodology. We are looking to track the direction of money flow. And when the Laguerre moves up and locks long, only institutional money has the power to do this. No set of commercial traders can lock the Laguerre to the upside and keep it locked to the upside. And that's when you buy long. You don't look to fade, you look to go long. Now here's on, those were stocks, here's our futures. Here's the Laguerre arrow on the cross of the 80 line down. We get a nice move down, the Laguerre lock. And then as soon as we get the up arrow, we're out. Same thing. Short on the cross of the 80 line, it locks red. As soon as that locked red steps aside and the indicator and the Laguerre line comes above the 20 line, we're out. Now, one other rule is we always trade short below the 50 and long above the 50, based on the fact that bears are in control when it's below the 50, bulls are in control above, and that it's going to really save you a lot of losers. Now, I wanted to compare this to stochastic. Remember, stochastic is looking at divergence or trying to capture divergence. You get the lockdown here, or you get the arrow here, signaling momentum is moving to the downside. The gears cross the 80 line to the downside. Stochastic crosses to the downside 2 candles earlier than the Laguerre. But look what happens on this 2 candle push to the upside. The stochastic moves above the 20 line and takes you out of the trade. The Laguerre remains locked down throughout this entire move. Look where the Laguerre line is. It never rises above the 20 line. So it keeps you in the trade because there's so much selling pressure here that the market is really not going to turn. And who are these buyers deciding that this is a bottom? This is a bottom. They're trading a reversal. Here's a bottom. They're trading the things I'm asking you to avoid. They're trading Elliot Wave, Gann theory, Fibonacci support, oscillator divergence, and MACD divergence. And they're all going to get beaten up and they're all going to fail. We are trading in the direction of a trend created by institutional money because it has pushed the Laguerre to the downside and locked it down. Same thing to the long side. Now we have 2 different signals. I'm not going to go into that because it's going to take up too much time. But there are 2 ways to trade our Laguerre long. We have an entry 1 and an entry 2. This is an entry 2. It's simply a pullback on these 2 unfortunate counter trend traders. And we know we're going to take the market down as soon as we get a down candle. Now, just one additional piece of information. These long traders really help us. One thing we always look to do on every entry is run over somebody because it helps push the direction of our trade in the direction we want. These buyers are going to have to sell their contracts in order to, as this price moves down. So our entry is always going to be off of a retracement. The retracement can be a wick, but better 2 up candles and then move down with the big money because we get to stop these traders out and they're going to push our trade really hard and fast in our direction. Now, when we do this, sometimes we get a snap down. When they get stopped out, this thing flies. Here's another example. And down we go. All right, now I'm going to stop here for a second, and I want to move over to a different deck. And I want to get to our slides and our whole platform, but I want to give you a little background if you're new. And look, I have the other slide deck here somewhere. Let me just find it. It may not be open. I'll have to go to my workspace and get it. Here it is. Let me just and reverse this here. Okay. Now, first of all, the system will work on any candle. It'll work on time, tick, range. Let me tell you why I like Uni-Renko. I used to trade range bars for a long time. And the reason I like range, now you can be very successful with time or tick, don't get me wrong. This is simply my take, and I'm giving you my perspective, is that I only want one independent variable determining when another candle forms. I don't want it to be time and movement dependent, or time or movement dependent and tick dependent. I simply want it to be dependent on how far the market moves. And that's range, Renko, and Uni-Renko. Now, I'm not even going to go into Renko and why it shouldn't be ever used. It doesn't create wicks, and those lack of wicks create lots of problems for you, including rendering oscillators useless. Oscillators need a wick because the open, high, low, close of every formation are 4 numbers that are required to put in the formula. Now, I traded range bars for a long time. You can trade a 5 range, an 8 range, a 13 range. I would always trade some multiple of Fibonacci. But Fibonacci does have nice symmetry and probably worked really well before the advent of institutional money. And I like the fact that range bars only form when it moves a specified amount of ticks or cents or pips. And it really creates a nice market structure pattern. You can read Japanese candlestick formations really well, rising and falling triangles, channels. Everything is read really nicely with range bars. But in the last 8 to 9 months, we have changed to Uni-Renko. Now, Uni-Renko is a unique kind of candle. We have a hybrid Uni-Renko. I'm not going to have time to tell you what the hybrid is. It's really a very unique candle, and I don't think you're going to see it anyplace else. Although I know from the traders in the room that we didn't invent it, that they've seen it before other places, but right now we're the only place in town that is using it. When we developed it, I didn't know anyone else had. But Uni-Renko gives you a nice symmetrical look at the market and gives you the ability to really see the direction that price is moving. Now, there's a lot of things about this. I could spend an hour and a half talking to you about Uni-Renko candles, and I don't have the time to do it. But you have to remember that Uni-Renko obliterates a lot of price movement within the candle body. And you can really get caught up and chop. And usually during a presentation, you'll always see a slide like this that just trends really nicely. You're not going to see a slide that has 2 up, 2 down, 3 up, 2 down, 4 up, 1 down. You won't see a period of time where there's lots of chop. And that's where you can really get beaten up if you trade Renko or Uni-Renko. My recommendation is to never go near Renko. So let's take a look at what we give up when we go to Uni-Renko. Remember, it does obliterate, and it's not price action, it's some price action. You can look at tweezers formations, dual bear and dual bull failures. You can look at consolidation. There's a lot of Japanese candlestick patterns that you can look at, but it does obliterate some price action. And so to some extent, on a candle by candle basis, using Japanese candlestick patterns, you lose a lot of that. You can't see an engulfing candle, a dark cloud cover, a piercing candle, a doji. You're not going to be able to use those. But in today's market, those patterns are really not very powerful. So you're not giving up very much. Now, it's a lot harder to discern rising and falling triangles, but you can see channels. So you are giving up some structure. And there's a lot of traders who will tell you they can make you $1 million trading rising and falling triangles, a J pattern called the hook pattern, breakout trades. These are not going to work, at least in a way they're not going to consistently make you money. So you're not giving up that much either, but you really have to have powerful leading indicators to get you into a trade. And they have to be indicators that function on a multi-time frame basis and that are purposed to track the flow of institutional money, allowing you to trade in that direction only. Now, they do allow you to filter out noise, which is really helpful. They give us great entries, and I'll show you all the entries I took today. So if you have really powerful leading indicators, they create really superior trading opportunities. You have to optimize the inputs for each individual market. You can't trade a Uni-Renko size on the Dow or the NASDAQ. That's the same as if you're trading the 6E or the E-mini. But we've optimized all those settings. Now I'm going to skip these slides. And I'm going to skip this slide because what I want to do is go to order flow. And I'm going to have to go through these things really quick because I'm already at 4:40 and I don't want to give the webinar until 6 o'clock. I don't want to take up that much of your time. Now, order flow is a really, let me start this way. Advanced volume analytics is really something that's just come out, I guess maybe in the last 3 or 4 years. I mean, first there was market profile, then there was a volume ladder. I mean, they've come out in different ways. I've never understood why anybody thought that market profile could possibly work, but you don't hear that being talked about very much anymore. I mean, market profile is, I think people have sort of understood it's not going to help you with your trading. And let me tell you, we developed an amazing market profile indicator. And it just became clear to me that the basic principles underlying its function were flawed. But market delta is important. Now, if you look at the bid-ask disparity of each tick value, what it's showing you is market depth. Are there more buyers on the dome or are there sellers on the dome? And if there are more buyers, there should be buying pressure on the candle. If there are more sellers, there should be selling pressure on the candle. Now, I wish to God it was simply that easy, because the sum of all of the tick levels on the disparities at each tick level gives you your market delta of that particular candle. And this is 2985, which shows you there's significantly more market depth on the buying side than there is on the selling side. And you would assume the candle would close to the upside. Now, if it was that easy, we would be able to predict the movement of a candle precisely every time. But we can't. And here's the reason why. Sometimes a positive delta occurs on a down candle. There's more depth on the buy side, but the sellers are more aggressive. So you get a positive delta on a down candle. Now, if that's the case, what's the value of market delta? And if you look at this chart, where these are all the deltas, this is a typical chart, and this is one we took off of our own indicator. And what it did is simply showed you a curve of the change in magnitude of the delta. But on the right edge of the chart, if this is rising, does it tell you that the next candle is going to close to the upside or the downside? It may tell you that the next delta is going to be positive, but that positive delta may be associated with a down candle. So the value of this is 0. And this is what most software packages use to track the market delta. Now, it really highlights two things. Market delta information needs to be formatted. And secondly, you can't use any information off your trading chart if you want to get forward-looking information. It's what you have to look at are the 2 higher time frames, because they're going to lead price on your trading chart. So what we've determined is that 1 standard deviation's worth of market deltas close in the appropriate direction. If it's green, it's an up candle. If it's red, it's a down candle. And anything outside of that single standard deviation, that bell-shaped curve, are the outliers, where the red delta is an up candle and the green delta is a down candle. The key is, how do we get rid of the outliers and just look at that one standard deviation's worth of data? And here's how we do it. And we do it really precisely. We look at the delta of each candle, first of all, on the two higher multiple charts. I put Uni-Renko, but it could be time tick. If you're trading time, you're looking at a 3-minute. Your two higher multiple time frames are 3 times 3 is 9, and 9 times 3 is a 9-minute and the 27-minute. If you're trading a 5 range, you'll get the two higher fibs, 8 and 13 range. Same thing with tick, the two higher fibs. If you're not trading a fib number, you default to the closest fib and then take the two higher fibs. Point is, we're looking at the two higher time frames. And what we do is we place each of those market delta values into a 15-period simple moving average. And by taking 15 different deltas, putting them into and averaging them over 15 periods, we filter out the outliers. So when both 15-period SMAs are sloping up, there's tremendous buying pressure in the market. And they both have to be sloping up, both higher time frames. When both higher time frames are sloping down, the bears are firmly in control of the market. And when the 15-period SMAs are not in agreement and the line is yellow, it defines chop. And it's really important to know when your market is chopping. Sometimes it's not so readily apparent. And here's order flow. Now, order flow is a leading indicator because this analysis is not looking at price on your trading chart. I mean, that's what you see usually. The line goes green because price rises. So big deal. What's it telling you? Is it going to tell you what's going to occur on the right edge? Here, price is rising because it's green. Because this green assessment are the two higher moving averages calculated off the two higher time frames. And these can only come into sync like this. This kind of buying pressure only occurs when there's institutional money involved in the trade. And when you see this green line, this is only a direction to trade. You must trade long. And anybody like this caught in the counter trend direction is going to get stopped out. Now, for other reasons, we wouldn't take this trade. But if you want to try to call a top, and I recommend you never do, you have to at least wait till order flow changes. Here's another example. Order flow turns green first, and price will swing up. You can't counter trend trade it. Same thing here. Green up. Yellow defines chop. When it goes red, you must trade short. Those two higher time frames and the market delta derivations that go into those two 15-period simple moving averages are telling you can't trade long. Here, have to trade long. Now, on this one line, it's a little tougher to see what's going to happen going out, but when the line continues to change color, it defines chop. And you can't trade in a chop market. You got to wait till the market trends. And I could show you a lot of mathematical derivations about why, on a mathematical basis, trading chop is going to create lots of losers. Now, I'm going to skip down here, past a lot of this. And here's what we've done. We've created that order flow assessment and projected it onto the candle body. So you don't have to look at the order flow line, it's gone. I make mine transparent and it disappears off the chart. All I want to see is the candle halo. You can make this candle halo any thickness you like and any color you like. But when you get an up pivot with order flow in your direction, you go long. Up pivot, order flow in your direction, you go long. Down pivot with order flow in your direction, you can take it short. But I'm going to give you other reasons why you just can't take this trade. What I'm trying to show you is if you're trading in the direction of the trend and your entry has order flow with you, the probability of getting a winner is markedly enhanced. And we deal totally in probabilities and the elimination of risk. What is the most important rule that what is the most important goal of a day trader and a swing trader? It is obviously to make money, but how do you do that? And almost everybody will tell you it's to get winners, but that is not the most important thing. The most important thing is to avoid losers. You will always get winning trades. Everybody gets winning trades. The worst traders out there get winning trades. What separates a professional trader from someone who's going to walk off a cliff real fast is the ability to avoid losers. That's why the goal of the software is to define risk for you so that you can know with certainty that you're taking an extremely low risk entry. Now, low risk doesn't mean no risk. It just means low risk. Right now, this week so far, I'm trading with an 82% win rate. It's right off of the Ninja Trader Dome. That's a pretty outstanding win percentage. And you really have to be able to define risk on entry in order to get that kind of a percentage. Here's another one, actually a similar example. Here, short. Now here you have we wouldn't count a trend trade. And you can't take the short, although you'd like to, because you don't have order flow. And one of the problems you're going to get are winning trades you can't take. But not having any FOMO, which is fear of missing out, is one of the traits of a professional trader. If the entry doesn't comport with their trading rules, they stand aside, and if it goes on to win, they say, I don't care. On entry, it had too much risk. And I don't have a crystal ball, and I'm never always going to be right. What's important to me only is that when I take a trade, it works. And those are our two short trades. Now, I'm going to skip all this. Now, I want to talk about the dots. And the dots are really something that you may not have ever seen before or even heard of. What we do is we also trade inside a small neural net, which is extremely important because a neural net tracks money flow. The whole principle of a neural net is based really on exactly what I'm telling you. No single financial instrument moves in isolation. What big money does is it moves money from asset class to asset class based on risk. When the risk is on, they're going to buy stocks across the board. And in general, the NASDAQ and the E-mini are all going to rise. Those markets correlate in a positive direction. When risk is off, they're all going to fall. When risk is off, or risk is on, when risk is off, where does the money go? It goes into safer vehicles, bonds, notes, precious metals, other areas. So what we want to do is track the institutional movement of money from sector to sector. So when we trade the E-mini, we have a set of dots, and what they do is they track the direction of the NASDAQ and the Russell, and they define a multiple trend. It's really a very complex trend that I'm not going to go into. I call it a 4-quadrant trend because it involves the 15 and the 50. But when we take an E-mini trade, we also must take the trade. If we take a long trade on the E-mini, we have to know that the NASDAQ and the Russell are rising on a multi-time frame basis. And if we want to track 3 time frames on the NASDAQ, 3 on the Russell, and 3 on the E-mini manually, we can make the same assessment. If we just want to do it off our charts, we can use this indicator because that's exactly what it's doing. And it will work against tick, range, or Uni-Renko, and I recommend to not trade Renko. Now, here are the dots. Now, these are more of our primitive dots. I haven't changed the slide in a while, but I'm going to show you the system. Now, when these dots are there, they're tracking the multi-time frame direction of the NASDAQ and the Russell when you're trading the E-mini. So if you get this down candle and you got green dots, you're never going to take it because you're not going to take a short trade on the E-mini when the NASDAQ and the Russell are long. And it saves you losers. And these are really invaluable. You're going to take the net. Now, they may stay green on the beginning of a downtrend, but this is a counter trend trade. And when we define market structure, you're going to see this is not a trade we would take. We'd look to take this trade long. Here's again another example. We've got red dots tracking the direction of the Russell and the NASDAQ when we're trading the E-mini. And we're not going to take these candles long when the Russell and the NASDAQ are going short on a multi-time frame basis. We don't use any single time frames, and we don't use any assessment based off of price on our trading. No forward-looking ability. And as soon as we get the pivot to roll and price to roll, we're into the short side. And let me tell you, there's no Gann theory or Elliot Wave or Fibonacci here. This is all institutional money flow. Same thing here. This is a long signal, no counter trend, long. And when you have no dots, that means you have no alignment of the NASDAQ and Russell. And the E-mini is likely to chop. And it really, again, is another way of helping you define chop. And this is another example. I'm pretty sure you get it. Again, just quickly, you can see that you get, whoops, what? The signal short on a green dot, never take. You're going to go long. The losers here and the winners here. No dots, no entry signals, all chop. It's a mess. It defines the mess. Now, the dot system is very successful. So what we did is we expanded it to include 2 time frames. One's a faster time frame and one's a slower time frame. So now we have the faster are the X's and the slower are the dots. Now, don't get scared by this. It's very intuitive, very easy. On an entry, we just want dual dots. Now, the darker the color, the stronger the trend. And that's what I meant by a 4-quadrant analysis. It's not just looking at the trend, it's looking at other things that I don't have the time to go into in this webinar or in this lecture. But we just want dual dots. And if we've got green in the direction of the trade, we've got a great long trade. We may not have it at the start, but all we need is a pullback. So we know that sellers are trying to turn the market, and then we just take it long on the dual dot. And here's the same, this is right off a chart. One dot, not enough. Dual dots short. Here's where you look for the entry on a pullback and continuation. One dot, can't take this trade. This trade, you just don't get in. There's your dual dots. I'm going to skip this all. Now, we also have an indicator that I think is the most direct assessment of money flow. And again, is part of our neural net. And I may be bogging your brain down a little with all this information, but when you see it in the full platform, it's all going to fall together, kind of like a jigsaw puzzle. We're down to one line. So what we've done is squeezed all this. And what we're looking at here, it's very easy to tell you what it is here on the E-mini. This is a more simpler assessment of the trend on the correlative markets. The dots are the more complex assessment. But we want to trade in the same direction that as markets do, that correlate in either the same direction or inversely correlate. So in other words, on the E-mini, we just use the Dow, NASDAQ, and Russell. We just use 3 markets. We used to use 9 markets, but we cut it down to 3 because we used to use bonds and notes as an inversely correlative market, precious metals. It was too hard to track 9 markets. So we cut these lines down. The only market we have 2 lines is the NASDAQ. Now, the key line here is right in the middle. And when that's green, we know we've got a really low risk trade. Money flow is moving into this financial instrument. Doesn't even matter what it is. And when there's no alignment, there's chop. So let's put it all together. And what I'm going to do is I'm going to put it all together right on the software. And here's the software. And let's look at it. And let me show you what we have. Let me show you a perfect entry. The NASDAQ top 2 lines. Now, the only indicator I did not talk about is background bias. This background is the most powerful assessment we have because a multi-time frame trend of the instrument that you're trading is the most powerful independent variable we have. There's a mathematical formula that relates the nonlinearity of independent variables. So every independent force that moves price out into the future is not equal in power. The one that is the most powerful is when there's a multi-time frame trend alignment of the instrument you're trading. Here's the NQ. This dark green means that on the 2 higher time frames, whether they're Uni-Renko, time, tick, whatever, the 15, here's the 50, here's the 15, it's crossed, and price, by definition, must be above both. So you've got yourself a great trade. Price has broken all resistance. The 15 is sloping up. The 50 is sloping up. And you get the green. Now there's 3 up colors and 3 down colors. And again, I don't have time to define them all. But this green is where you're going to find the majority of your lowest risk trades and is without a doubt the most important indicator on the chart because you're never going to get a triple alignment and trend of the market you're trading without institutional participation. This is not going to happen. It just doesn't happen by random chance. It is only when the markets are powering this up and you get a 3 time frame alignment in price. Now, would you try to trade this market short in that environment? I would not. But you're always going to find traders who do, and they're always going to get stopped out. And what we're going to do is look to leverage their mistake and capitalize on it. Now, this is a very special 50. It's a 50 EMA of a 50 EMA. This is a 15 EMA of a 15 EMA. And to put it all together for you, as if it probably isn't confusing enough, these are our quant lines looking at correlative markets. And on the NASDAQ, they're looking at the Dow, the Russell, and the E-mini. And when they're both green, the bottom's the slow, the top is the fast. When they're both green, you have strong money flow into your instrument. When they correlate with dual dots, which are also looking at those same 3 correlative markets in a different way, that makes the risk even lower. And here we have a multi-time frame assessment of the Laguerre momentum. That green line and this green line is assessing the Laguerre on 3 time frames. This is one where we use the chart Laguerre, but we also use the 2 higher time frames right above it. When all of this is green and background bias is green and we have a multi-time frame alignment and money is flowing into the instrument, we wait for some trader to take a counter trend trade. This guy. And what do? We go long. We capitalize on his mistake and run him over. Now, what is the candle halo? Order flow. It's that multi-time frame assessment of the market delta. So now you can get a perfect assessment of risk on entry. There's no, it works sometimes, it doesn't work other times. There's no, I don't know the sensitivity and specificity and positive predictive value of this entry. You know this is an extremely low risk, likely high reward trade. You're in 1 tick above the close and you get this whole move. This is our bread and butter trade. And it's very intuitive and very easy to catch. And let me just talk really quickly. I've only got an hour, which isn't too bad, about the pivots. Pivots are incredible pains in the neck, but they're also incredibly important, and they give us a tremendous ability to get great trades. And let me tell you why. Remember how we always try to leverage the counter trend trader, try to leverage traders caught in the wrong direction? Well, let me give you an example of what we do with the pivots. Just have to find one right here. No, hold on. That's a great move. I can show you the trades I took this morning. I'll find them later. But let me show you. Okay, here's a great example. Let's take this example right here. First of all, most pivot indicators create pivots at the wrong spot, and it creates a lot of problems for you. Japanese candlestick makers back in the 400 years ago said that pivots come off of a candle body, not a wick. Now, the only reason it seems that pivots trace off the wick is because it's easy to code. But the fact is, this is where all the buyers are. The fact that sellers pushed us this This wick through here doesn't mean anything. This is where those buyers are sitting, at the base of the candle body. Now, you know they're waiting here to turn the trade when price comes back to it. Now, the only thing that takes out a pivot is not a price breach. It's a 2/3 candle close below the pivot. That's the breaker. Not this candle, not this candle. And the advantage of taking the pivot breaker, when everything below you is red, both quants, looking at the correlative markets, the E-mini, the Russell, and the Dow, the multi-time frame assessment of the Laguerre, momentum, order flow, candles haloed in magenta, it's heading down, it's a multi-time frame analysis. You've got a multi-time frame trend to the downside on the NASDAQ. Is that pivot breaker is where all of these buyers get stopped out. And it snaps through the pivot. Right here is a pivot breaker. You can't take it. Because I saw this multi-time frame Laguerre went green. And it shows you how it's tracing out from other time frames. I mean, on a falling market, you get a green calculation. It keeps you out of a winner. It's going to happen. But when you take a trade, it's going to confirm that the trade is successful. And you just get it here. There's your pivot breaker, and down you go with everything. Now, this morning, I'm trying to remember exactly where I took them. I had one loser on the NASDAQ, and I had 3 winners and 1 winner on crude. And I'll show you the crude. Well, I'm not going to show you the crude trade because it was a complex trade. Here's your perfect trade right here. There's another one. And up. Now, the few other lines, this is the volume weighted average price, the VWAP, support and resistance. You want to trade long above it, short below it, and in general, don't trade into it. Price can bounce. And here's the 50 and the 15. We also have on the chart if I can find it. Here it is. Well, hang on. Let me squeeze it. Because these are also very important areas. Just so you know what everything is. But it's really very easy. I want to show you 2 system generated entries. And then I think we'll pretty much have it all. I've squashed a lot. Here is the open. And here's yesterday's close. So these are also important areas of support and resistance. And if you break yesterday's close, 2/3 candle body, this one you can't take because order flow is against you. You're likely to get a nice run up. Now you don't have to take the pivot breaker. You can move over 1 candle and take this one and wait for order flow to move in your direction. But in general, a trading methodology looks like this. I mean, you're looking for a pullback, or you look for a break, retest, and a move up, or always trading into the trend. Long above the 50, short below the 50. We wait for all those time frames to roll, and when they do, we get really, really good trades. Now, we have 2 system-generated signals, and they do have to be vetted by you. Now, look what happens here when there's no background bias. Look how the market trades. In chop, you can't trade here. And it doesn't matter whether you're trading minute, range, Uni-Renko, or time. You're not going to get a trade in this interval because there's no multi-time frame alignment. There's no market participation by big money. Look what happens to the quant lines. They never align, green, green, or red, red. Look what happens to the Laguerre. It never aligns, green, green, or red, red. A second here it does, but you have no trade. So it really does keep you out of chart. Now there are two software generated entries. This is one. It's called the continuation signal. And it's awesome. If you take a trade with this, it's very likely to give you a winner. And what this is a multi-time frame assessment. I'll open it up for you, of a range chart. It's looking for an alignment on 2 time frames of range to align on a Uni-Renko. Range and Uni-Renko have a lot in common. The only thing that determines when a new candle is formed is price. There's no time component or tick component. That's a terrific entry. And when you get it like this, where the 50's red, the 15's red, you got dual dots, you've got both Laguerres, and you have order flow, and you pretty much have both quants, and you have pink background. The software is defined the risk. You're in the trade, and you're going to very likely get a winner. And let me show you the other one. Here it is again. Pivot breaker, and there's your winner. Now we're in the process of building an automated system, and this is going to be one entry as long as everything else is there. The other one is called our revolution signal. It's not even complete yet, but it's still worth watching because it looks at about 80% of the independent variables we're looking for in a trade. It's not as powerful as the continuation, but it's a good entry. You just have to, again, check out where you are. And sometimes it'll call 5, 6, 7, 8 winners in a row, but you have to just be careful with it. These are 3 trades in a row I took yesterday. First trade down, I made 5 1/4 points. There were the long traders. I really loved it. Took the trade short right here. I took it out at the pivot because I did not anticipate a pivot break. Then when the pivot broke, I took it again and took price and took it off again right here. This was a very lucrative move. 5 1/4, 3.75, and 3 points. 3 separate entries all the way down, all with both quants. I knew that money was leaking out of this market because I knew the NASDAQ, the Russell, Dow, and E-mini were heading down. And Laguerre momentum, I had my multi-time frame assessment, I had my chart assessment, and I had the NASDAQ down on multiple time frames. So I banged out 3 winners in a row and closed. Those are the last 3 trades of the day going into 11:59. They're right there. And I could define risk exactly based on the software. Now let me show you one other thing. I have to put it in. Didn't have time to do it beforehand. Hopefully it'll populate in aftermarket. Some traders like to look at a lot of different markets. I'll just give it a minute. There it is. It's called our scanner. Now the scanner, since the market's not moving, I should have left it up from the morning. But it looks at all of the things that we look for. And when this alert goes off, it's telling you that you've got pink background, the 50's down, the 15's down. You've got dual dots. You've got order flow in your direction. You've got the quants, and you've got the Laguerre. So the alert goes off. It doesn't tell you necessarily have a trade. You always trade a pullback or a break, but it tells you the likelihood of a trade entry is very high as being a winner. You can set this up on as many markets as you want. And I'll show you, I'm going to put one. Here's the E-mini. And I'll show you the E-mini chart really quickly. The E-mini today was a killer chart to trade. And you just put the dashboard in. And what I like to do is I stack them. I stack them and rack them. Just have to find it. It'll take a minute. The E-mini dashboard will come up. It'll look exactly the same. And you can have 10 or 11 futures markets here. Doesn't make any difference. But when that alert goes off, that's when you pay attention. If it's not going off, you're in a risk zone because all of those independent variables are not aligned. When it goes off, they are aligned. It's not an alert to run in and trade. It's an alert to move to the chart, and hopefully you're going to get a great entry. Now, I don't see the E-mini coming up, but it will in a second, I believe. Let's give it a minute. It's right here. No, I don't know why it's not here. It's probably because the market is half dead. But you're going to get another one that says yes, and another one. It still may eventually come up. I don't want to refresh. I'll refresh the chart quickly. See if I can't get it to come up. I'm sure it has to do with the fact that the market's pretty much dead. And also that I'm giving a webinar where if something can go wrong, it will. But you can put up 6, 7, 8, 9 gold, bonds, notes, natural gas, whatever you want to trade, and ignore the markets. They're not giving you an alert. Well, let's see if it comes up after I hit F5 and refresh the chart. Well, it doesn't look like it wants to. But let me show you the great trades on the E-mini. And we're going to look for losers too. Now, right here is a terrific trade. We've got the counter trend trader trapped. We've got dual dots, green across the bottom, and we take the trade long. Now we can only trade long here, no short. Now this is a potential trade in a winner, but we don't have this quant line. And this is a money flow line, so we don't take it. And it's yellow throughout here. See all these trades, they go nowhere. They go nowhere. Right here, you were saved 2 losers because this money flow line was yellow. That's our goal, to protect you from taking a loser. Now, you see this wick right here? You can take that pullback and long. Now it goes yellow right here. We don't have the multi-time frame Laguerre, which is right here. So we have no trade. Right here, again, we have the quant, the multi-time frame Laguerre, and the chart Laguerre. The wick for the pullback and the continuation. Now we're going to look for losers. Now, this is a potential continuation, but look what happens at the pivot. Price cannot get past it, and we never trade into a pivot. You got to trade around it. Unfortunately, well, there was no trade here. We had no quant, no multi-time frame Laguerre, and no order flow. It's all down. Forget it. There's your next trade right here. Not a biggie. You're going to take it right off at resistance. Right there. Here, you have nothing. No Laguerre. Here's your next trade. Break of the pivot. Snap and up. Now that's how many winners in a row. Now I'm telling you, there is no loser here. Can't trade when this is yellow and this is yellow. So all of this movement in here is not tradable. When it's all green, there's your trade. All green here, but you have no trade. Your chart Laguerre is sagging. So you have to sidestep that. Now this is at 1500 hours. No background bias, all chop. You're out for the day. So you have 1, 2, 3, 4, 5 winners. And I'm telling you, there is no loser. So that's our goal. And our scanner, and God only knows why it's not coming up on the E-mini, is available to allow you to trade multiple markets. I just want to put it on the Dow and see if it comes up. I'm not going to kill the Dow here. And the Dow doesn't even have our full system on it. But I just want to see if the scanner comes up on the Dow. Hold on 1 second here. There it is. There's the Dow. And let me try this. Just give it a second. And then I'm going to stop because I'm going on an hour and a half. Only this is a complex system that's very intuitive. I really wanted to give you an overview of how it trades. Now, if you're conservative with it and you understand the rules, it's very tough to take a loser. We have a lot of profitable traders. We have 175 traders in the trading room. And I've had a profitable trading session every day this week. There's the ES. And you can see how you can stack them and trade as many instruments as you want off of this alert. You don't have to spend time staring at a chart that has no background bias, because you're likely to get a loser. No money flow, because you're likely to get a loser. No dot confirmation, because you're likely to get a loser. And only trade during the times when you can cherry pick the best trades. Our software is purposed to define risk. It's a multi-time frame assessment. It almost always looks at the 2 higher time frames. And it's a very, very strong, it gives you a very, very strong ability to predict when you're going to get a winning trade, or the likelihood of getting a winning trade. If you can avoid FOMO, which is fear of missing out, and chase a trade that doesn't fit with all your rules, and you trade conservatively, you're going to do really well. We provide you with automatic trade management strategy. In other words, if you want to trade the E-mini, we're going to give you our best recommendation for stop, first, second, and third targets, depending upon how many contracts you're going to trade. And that's going to be based on the average true range of the instrument. I mean, we give you everything. And we do the tech setup for you. You don't do anything. And you get, and I mean, we do a lot of support because it's a complex program that assesses multiple time frames and multiple markets. It's unique that way. I mean, this is looking at 3 markets on multiple time frames. This one's looking at 3 markets on multiple time frames. So it ain't easy, but it gives you a great assessment. And let me just show you our offer. And I'm going to drop the dashboards. It's normally $29.99. The special offer is $13.99. You'll always get upgrades. And let me tell you, we do a lot of upgrades. We're already considering a couple, and you get those for life. With it, you get a 10 module. We don't give it to you in weeks. We just give you the whole 10 modules all at once. You come into the trading room and trade with me for a month, which I believe you'll make your money back here in 1 week. I hope. I can't guarantee, but we're approaching. We're right at $1,000 this week right now. If I can make 300 or 400 tomorrow, we're there. 1 month with me, you get 450 videos, and the first 5 will get that market analyzer. This tool. Normally we charge a lot for it, but we're going to give it to the first 5. And it's going to allow you to watch the alerts and cherry pick the best trades on any markets you want to monitor. You can market as many as you want. You have 12, 13, or 14. If you want to monitor wheat, corn, and soybeans, you can. And back in the day, I used to trade soybeans, wheat, and corn. Only now there's no volume. Back then, it's really good volume. Our number 786-713-5276. The offer expires on March 24th at midnight. And it's our first offer for the full system in quite a long time. Now, let me see if there are any questions. Now, this webinar is information heavy. I've seen a million, and most of them are not. They're promotional heavy. They're heavy in people telling you how much money they made, testimonials, and people talk about how they went from, living under a bridge to driving 23 Porsches. But I wanted to give you a really, really in-depth look at how we trade. It takes time, it takes effort, it takes patience, and if you have the diligence and the I'm trying to think of the right word, but to wait for your trades, make the market come to you, and let everything align for you, you're going to get a bunch of winners. And if you're in the chart, and if you were in the trading room today, you would have seen me project 3 naked pictures of me. 3. And I can't show them to you here because they're too embarrassing. But we have all kinds of wonderful things going on in there. And I don't show naked pictures of myself often, but I did. And everyone in the trading room will tell you that that's absolutely 100% true. All right, now let me hang on a second. Let me go to the top, and I'll go through the questions. Hey, Ford. Hey, Eric. Thank you. Thank you, Eric. Eric said, congrats for the gear. It's amazing. Hey, John. Wouldn't most of the volume in those 1 to 2 bar pullbacks be just profits? They may be, John, but in order to take profits, they still have to buy the contracts. And when price moves against them, they got to sell. I mean, if they're caught in the counter trend direction, they got to get rid of them fast when price moves against them. You're absolutely right. They could be profit takers or they could be traders just calling a bottom or a top. But you're absolutely correct, John. That's a really smart, observation. Tamir, we close trades based on our predetermined automated trade management strategy. For the NASDAQ, we trade 3 contracts. We take 2 off at 20 and we take 1 off at 30. So we're looking for 7.5 points on the NASDAQ for a full winner. I often intervene because I'm so conservative, but we trail the trade and we take the trade off, hopefully at our two pre-programmed targets. So once the trade is entered, it's all automatic. You just sit back and watch it. If it comes up to a pivot, I'm going to tell everyone, close, and you're going to close the trade. But you're going to be able to anticipate that as we approach a pivot, we're not going to anticipate moving through it. Let's take our profit, and then if it breaks the pivot, we're going to go back in. So closing the trade is all predetermined. Vic says, where's your stop and first profit? Vic, it depends upon the instrument. We have to take a 25 tick stop on the NASDAQ based on market structure. Our first target is 2 contracts at 15. So at 30 ticks we make on the first target, we've locked in a winner. And even if it comes back all the way, we make money. Now I have a tendency to bring the stop to break even. Once we hit our first target, we've locked in $150, and we look for that second target to lock in 275. So that's how we do the trade. It varies though from instrument to instrument. Okay. That's a good question, MP. Okay, Russ. How do we open a second or third chart? Example, if we are looking at E-mini, how do we put up a new separate chart for the NQ? It's really easy. All you have to do, first of all, you should have all these charts pre-formatted, Russ. I mean, all the markets that you want to trade should all be already open and off to the side. I mean, I have them all nestling in a corner. But let's say all of a sudden you want to open up a new chart. Let me find the control panel. Hold on a second. It's here somewhere. It takes a second. It's right here. All you do is go to File, New, Chart. And let's say you want to open up a chart on gold. Bring it down. 5210 is correct. You load 3 days and you hit OK. During a live session, it's going to load faster. There's your gold chart. Then you just right click, go to templates, load, bring this down, and go to GC. LTL, hit it, and there's your chart's going to come right up. In just a second to load. You get all these templates. Now you should have this chart already up. If you have any intention of trading gold, you should be ready to roll on it. You shouldn't have to create a new chart. But if you forgot, after hours, it's going to take a minute to load. And there's your gold chart. All set to go. Complete. Everything. Okay? It's very simple. I'm just going to close it up. Now, if I wanted a dashboard, I just go into indicators. I go to RL Uni. Put a dashboard on it, hit OK. When it recalibrates, there's the dashboard for gold. And the only time I'm going to look at gold is when I've got that alert flashing on the right. That's looking at everything I need. So I'm going to take gold, I'm going to fold it up, put it off to the right, and when I get that flasher, I know to open gold and look. Okay? Absolutely, Rob. I just put up a gold chart. You can trade any future you want. Natural gas, corn, soybeans, wheat, whatever you like, you can trade. We'll create the template for you. We have about 12 templates. We have a DAX template. We have a 6E, a 6A, a 6J. We have all the currencies. If you happen to want to trade a specific future, we don't. We'll make a chart for you. We'll make a chart template for you. That's not a problem. Hey, Les, I like what I see. Is it safe to say that I should abandon the RLTs that I purchased? Yeah, I mean this is the premier, Les. It's a completely reworked system, completely. Greg, unfortunately, it only works on Ninja 7 or 8, but you have a couple of options. If you have Thinkorswim, the Thinkorswim data feed will power it. So, I mean, we have an API for that. So we take your data feed from Thinkorswim and it runs Ninja. So you basically bring up a demo and you can take the signals off of Ninja and take them on Thinkorswim. There's a few other platforms we can do that with as well. You'd have to call Rory to be sure. I know Thinkorswim is one. I think Interactive Brokers is another. Owanda's another, where you have to trade off, and you have to take the signals on Ninja and move them over to your trading chart, but your data, to your platform that you have the broker with, but the data feed, we bring it over, and so you power it, and you don't pay any money for it, because you've got the live data feed and the demo of Ninja. It will last you forever. That's an option that you do have. And we do have a lot of traders on Thinkorswim. Hi, hey, Philip. Listen, there's always discretion on the automated Ligier, opt out of a trade. I'm not sure what you mean by automated Ligier, Philip, because automated is making the supposition, because we're developing an auto trader that's going to take these trades for you without even you looking, and we're going to have it active on 9 markets. We don't really have an automated system here. There's always some discretion, but there are just some trades that are so overwhelmingly perfect that you just gotta take them. And there's some trades that are so bad, you should never take them. And then there's some trades that are in a gray zone. And somebody asked me a question who left, and they said, what happened on the trade you lost? And you know what happened on the trade that I lost today? It was a perfect entry that didn't work. I don't want to give you the impression that a perfect trade is always going to work. They're not, but they're going to work 8 to 9 out of 10 times. I hope I answered it, Philip. If I didn't, you can re-ask it again. Thank you so much, Raymond. Okay. Thank you, Vic. I appreciate that. The time length of the winning trades, Celeste, they're short. Maybe a minute to a minute and a half. We're just day trading. The NASDAQ, moves like wildfire. It is really quick. So we normally don't stay in these trades. They just evolve quick. If you look at YouTube, you'll see I videoed 2 of the trades I took yesterday, right at the open. I mean, at 9:39, we had almost $500 in profit on 2 trades. Each of them lasted maybe 60 seconds each. So they're fast. But you always have time to get in. I will tell you that. Okay. Okay, Russ. Good. Thank you so much, Russ. Russ is good stuff, Mark. I appreciate it, Russ. It's nice to see you. Thank you, Raymond. Thank you, David. Sergio worked on it all day today. He's talking about our NDT. Thank you, guys. It'll absolutely trade bonds, Bill. We got a great bond platform. And you know what? I'll even show it to you. I'm gonna drop this, move this to bonds. I'll put the bond template in. Bonds is a great instrument if you can handle it. You have to have an enormous amount of patience, and you really have to, goddamn, NinjaTrader collapsed. I'm really sorry. That's what happens sometimes with it, Bill. Trust me, it creates a great bond setup. Here's the thing though, Bill, you're probably only going to get 2 a week. But when you get them, the likelihood of getting a winner is exceedingly high. The correlative markets in bonds and notes are great. The multi-time frame alignment is great. The Laguerre helps you immensely. When you get a free and clear bond trade at 31.25 a tick, you're going to get a nice trade. And I see when I review bonds, it normally will set up maybe 3 times a week if you're lucky, usually at least twice a week though, twice a week. But I've seen bond trades that have to be held overnight. If you can't do that, you'd have to close because they don't move fast. But we get great bond entries. Vince, I trade crude and the NASDAQ in the room. The E-mini works terrific. I don't trade it because it's a little more, it's boring. And sometimes boring is good. You know, you may get a day where you get no great trades and some days where you get 3 stellar trades. The important point though is you're not going to get pulled into a losing trade very often. You know, you're going to get 8 to 9 out of your trades winners on the E-mini especially because it just doesn't move crazy. And when you trade the E-mini in the same direction as the NASDAQ, Russell, and Dow, you're only going to take a trade when all 3 of those other markets on a multi-time frame basis are moving in the same direction. So you're very likely to get an E-mini winner. It's a very good chart. I just happen to really like the NQ. I'm kind of fixated on it. But as a beginner or a starter, I would recommend the E-mini. And the E-mini alone can make you great money. You don't have to trade 2 instruments, just trade 1. And when the E-mini gives you a low risk, high reward trade, just take it. And you should do extremely well. I like the E-mini chart a lot. The correlative markets are good, and it's a real tight trade. Crude is good too, but crude lately has been miserable to trade. Thank you so much, Brian. Great webinar. I learned a lot. I greatly enjoyed trading with right line indicators, and I find it very profitable. Thanks for all your hard work in developing truly unique trading tools. Thanks, Brian. Brian, I really appreciate that. Hey, God bless you too, Philip. Really. I always keep in touch with you. I really appreciate it. A lot of guys from the trading room in here today. All right, well, listen, that's it. I hope you have a wonderful, wonderful evening. I hope you'll come aboard. My goal is to make money for you. I swear to you, I live and die for this. It is to make money in that trading room in the morning. I really do. In order to use the automated system, does one have to have this platform first, Celeste? The answer to that is no. And I'm going to be honest with you. You don't need this because the automated system will place the trades on a bare chart. If you want to be able to understand what it's doing, you need the software. But if you just want to trade it automated, you don't need any software. Thank you, Giovanni. John, thank you. Always appreciate your honesty and generosity. Thank you, Giovanni. I really appreciate that. You're a really nice guy. So Celeste, you don't need the software to trade automated. You need the software to trade on a discretionary basis only. So that's the scoop on that. So listen, everyone, again, great evening. Hope to see you aboard. Thanks, John. We're working on those. We have a great Forex system. John wants to trade Forex. We're going to make those templates for John. Okay, everyone, take care. I hope to see you in the room, no matter what you do. I really hope you guys make money. We're the small guys. We have to beat up the other small guys because we can't beat up the big guys. Exploit their mistakes, and that's the only way to make money. Take care and have a wonderful evening. Bye-bye.